Hi, my name is Donnell Green. I'm a mortgage loan officer, and I'm here to help you out with all your financial literacy, home ownership, and home buying education so I can help you and your family build generational wealth. So today, just want to go over a few best practices for managing your credit. I have a few tips for you that's going to make sure that you can help keep your credit strong. So if you find this video useful, do yourself a favor by making sure you subscribe and also pass this video on to someone, family or friend that can use this information also. So first tip I want to go over today is making sure that you limit your number of revolving credit lines. So you might be asking yourself, what is a revolving credit line? Revolving credit line is going to be any type of credit account that as you pay that money back, the funds become available to you to use again. So that's going to be your credit cards, your personal lines of credit, and your home equity lines of credit. Those are going to be your revolving credit accounts. So I want to make sure that you limit the amount that you have. As I said, there's not a one-size-fits-all number of credit cards someone should have, but generally speaking, it's best to have about 2 or 3 credit cards that you have active, in addition to having other types of credit such as student loans, auto loans, personal loans, and mortgages. This is going to help you. This combination of different types of credit is going to make sure that your credit mix is where it needs to be at, which if you saw my previous video that talks about what determines your credit score, you'll know that 10% of your credit score is based on your credit mix. But the number of credit cards that you own is less important than how you use them. So you want to make sure that you can keep up with your existing credit accounts. You want to make sure that you manage your existing monthly payments before you decide to take on a new credit card. The biggest risk that anyone really runs into is they can easily spend more in credit than they actually have available to repay back in cash. You got to make sure you stay on top of that. Plus, keeping track of multiple credit cards with different interest rates, due dates, minimum payments, and other fees, it can be overwhelming. So you can kind of lose track of things that can kind of put you into a hole. So want to make sure that you don't take on too much revolving credit. Tip number 2 for you: stay below your credit limit on your credit cards. Follow the 30% credit rule. So 30% credit rule, what that is that whatever your approved credit line, so say your revolving account, if it's a credit card or a personal line of credit, whatever the case may be, say your credit approval is for $1,000, you don't want to exceed 30% of that limit as a balance. So you don't want to exceed a balance on that $1,000 credit line of $300, because that's 30% of 1,000 is 300. So you don't want to exceed that amount. As you start to exceed that, your credit score starts dropping. So you want to stay at that 30% threshold or lower. That's going to be the best option for you. Tip number 3, pay what you owe. Make sure that you make full payments. You might be able to request bi-weekly payments with some of your creditors, but you want to make sure that you're making the full payment. You don't want to pay less than what you owe, because that is going to hurt you. That's going to put you into a tougher situation, more debt, more fees. It can be a late that's reported on your credit, so you do want to make sure that you're paying the full amount that you owe. And to piggyback on that, tip number 4, pay attention to the payment due dates. Pay what you owe and do not miss any payments. Avoid 30-day lates. One thing I would suggest for anyone, I know some people feel different about this, but set up an auto pay. Just set it up for the minimum payment. Make sure that you keep track of when your payments are going to come out to make sure that you have the money there. But you do want to make sure that you set up auto pay, just so when life happens, things are going on. Sometimes hardships come around that kind of throw us off track when it comes to paying our bills. Things happen. So at least when you have auto pay, that payment won't be missed. But you do want to make sure that you avoid any 30-day lates. That's the most important thing. So it's better to, even if you're going to be late, a few days late, it might get you hit with a late fee, but definitely avoid any 30-day lates. That's when it's going to actually report to the credit bureaus, and that's when it's going to have a negative impact on your credit score. So that's really important. Tip number 5, keep your contact information current. This will help you avoid missing any important notifications regarding your accounts. So if there was maybe a change of servicer, on your mortgage. You need to know that, so maybe I need to set up reset up my auto pay with a new servicer. So if you maybe change the maybe where you get your mail delivery, you're not going to receive that information. So make sure that you keep all your contact information up to date. That's really important. Tip number 6 for you. Tip number 6. Have at least 3 to 6 months worth of living expenses. So basically you want to estimate your costs for your critical expenses, such as your housing, food, healthcare expenses, including your insurance, utilities, transportation, personal expenses, any debt payments that you have. You want to make sure that you come up with a budget of what you have to pay every month, and you want to try to make sure that money is set aside, 3 to 6 months of it, that can take care of any type of hardship you might run into. So make sure that you can keep those bills being paid as you're going through whatever situation you may be going through, because things do happen. So you can build it up by basically taking a little bit of money out of your paycheck, putting that to the side, like every week, every paycheck. And if you keep doing that, eventually you're going to meet your goal, what you need to save up. So for example, if you set aside $25 a week for emergency fund, at the end of 2 years, that's going to be $2,600 that's going to be saved up after 2 years. So if that's what your total expenses would add up for 3 months or 6 months, whatever the case may be, then you have that saved up if you do $25 a week. If you increase that to $50 a week, then that can easily grow to $5,200. And $75 a week, that can be $7,800 for you. So this savings plan can definitely help you establish that nest egg that you need, that 3 to 6 months, kind of depending on what you need to have set aside and how much you're able to do. So doing something is better than nothing. So I definitely would suggest doing that, just in case, again, something comes up. Or also if you have a big a big transaction in mind, like that requires a down payment, like maybe you purchase a new car, purchasing a home, that can also help you doing that. That can put some money aside for your down payment. So stick to creating yourself a savings plan. And the last tip for you is keep your new credit lines at a minimum. So you do want to make sure you're not continuing to open up a whole bunch of new accounts. That is going to be towards 10% of your credit scores based on new accounts and new inquiries. So we want to keep that in mind. And not only will that impact your credit with that 10% of your credit score that's determined by new accounts and new inquiries, but also it impacts your credit history, the length of credit history. So if you have 5 years of average credit length, for example, and you open up a new account, that new account is going to shrink that credit history down. So you do want to make sure that you're aware of that. So it's really important to make sure you're not opening up a whole bunch of accounts. Only make sure you open up accounts that you need. You don't need to go and say, I want to save, this 20% on this purchase at TJ Maxx. I'm gonna open up a TJ Maxx card. Stay away from that. I would say, when it comes to, like I said earlier, 2 to 3 credit cards is great. You want to have some cards that you can use like for major purchases. You want to maybe that you can use anywhere. Maybe like just for example, not pushing anyone's card, but say like if it's a Capital One or a Bank of America or something like that. Like those type of cards you can use anywhere. Versus if you're doing a department store card, you can only use it there. And really, it's all it's do is keep you shopping. So just keep that in mind. It's best to have like a card that you can use everywhere, or maybe a card that you can use to get maybe some travel rewards, things like that, or some points. So that can then give you some extra money back in your pocket. And as I mentioned in the previous video, that most people that are transactors, that actually have great credit, they're actually able to pay off those cards every month, and they reap the benefits of that card because they're now getting rewards. Instead of them paying interest on the card, they're now getting paid basically interest by the credit company because they're getting those points back. So I hope that this video was able to help you out. If it was, please do me a favor. Make sure that you subscribe. Make sure that you are following my Instagram, you're following my YouTube, and you are clicking on that notification bell to make sure that you're notified when I have a new video. And last, make sure that you share this with someone. Most of us know someone that needs to know this information. So there's more different types of topics that I'm going to be talking about. So I have plenty more to share with you. So I hope everybody enjoyed it. I'll catch you next time.